Just like to say to start with that I'd like this to be really interactive. So I'm going to ask some questions, and then you'll have a chance to ask some questions. So if you want to interrupt the first half of the discussion, just put your hand up, and we'll take some questions as we go along. The idea is just to get things going, and then we can all chip in and be part of the discussion. So I just want to start really by saying that you have before you, three very different kinds of organizations, or people who represent three very different kinds of organizations. But they all have one thing in common. They're all after the next big startup. Okay. So they're getting on well at the moment. Okay. But one of the things I'm sure that we'll all want to probe is, which one of them would be the best one to go to if you were a budding entrepreneur and you had a startup and you really wanted funding. So I'm going to start just with Damien, and then move on to Jenny and Varuna, and ask you to just briefly say something about your industry. So this is your chance to say why the best entrepreneurs should go to a VC firm as opposed to an angel investor or a crowdfunder.
Sure. So, look, I think it's all due to timing. So when you're at the right stage for a VC investor, something that we're unique in Canada. OMERS Ventures is fairly new to the market. We're 5 years old. We're the largest, most active fund in the country. And one of the things we offer to our investee companies is really access to a large global network. OMERS is a $100 billion pension plan with offices in Toronto, obviously, New York, London, Sydney, and those operations span globally. One nice thing I can offer to technology is small technology companies that we invest in, and we invest in anything from $500,000 early stage to 40 million in a late stage financing. One of the things we offer is access to that network. So, being able to go to a small technology company that maybe has a piece of software that they sell into real estate and saying, hey, how would you like to meet Oxford Properties, which is part of OMERS, and manage $30 billion in real estate across the globe? That's a huge advantage to an early stage tech company. Similarly, if I meet a tech company that sells into retail, our private equity group owns a bunch of retail places. It owns one of the largest grossing malls in North America. Our infrastructure group owns the largest nuclear power plant in North America. So these are things that a lot of venture funds, claim to be able to add value. Yes, I try and add value personally, but more importantly, I provide access to this large global organization that I work for, which tends to really resonate with early stage entrepreneurs especially.
Okay, so there is a lot of talk about the rise of the angels, the rise of the angel investors, who may not be part of a large VC firm such as yours, but at the same time have a lot of capital to invest and are willing to perhaps work at a slightly different level. So Jenny, can you say a little bit about the angel investor industry and how that's changing, and make your pitch perhaps as opposed to Damien's pitch?
Yes, thank you, Kathy. So for all of you who don't know about angels, angels are individuals who invest their own money. They take their own decisions about the businesses that they want to invest in. But they're not just bringing their money, they are generally, on the ones I know and work with, have themselves built businesses and built and grown businesses, sometimes several. So they're bringing to you not just their money, but they're also bringing to you their contacts, their business knowledge, their understanding of what it is to be a small business and grow it, but also market access, customers, strategic advice. And that's really what you particularly get with an angel. It is different because Damien's looking after somebody else's money. These people are looking after their own money, but they are prepared to take risks. It is very patient capital. They can bring, the angels I work with all invest in groups. So you tend to have a lead angel, who's the person who really gets involved with your business, but behind them there may be several angels and therefore several areas of skill and knowledge that you can access. But the most important thing is angels bring patient capital. They can do several rounds to help your business grow. And usually the person who is getting involved with you is someone who really aligns with your interests. So that means that they are not looking to take substantial amounts of equity. How much equity do you take, Damien? Normally. Come on, tell us.
Between 10 and 25%.
Right, okay, well, we'll deal with that. Okay. They tend to not take so much equity in the early rounds. They are very aligned with you. They have ordinary shares, mainly. What kind of shares do you take? Pretty tricky ones.
Mixture of common and preferred shares.
Yeah, they get preferred shares. That means their shares are always ahead of you. When the chips are down, they take their money out first. So the angels are always aligned with the businesses in that they take ordinary shares, so the same kind of shares as you, and generally will want you to succeed, but they are not there to rush you to exit, and they're there to work with you. And just to give you a bit of a flavour why this is such a growing market is that latest stats are that 1.6 billion pounds, yours were dollars, weren't they? 1.6 billion pounds were invested in small businesses last year by angels. If you compare that with venture capital, this is in the UK, at the early stage, I'm not talking about the later stages, that was about 400 million. So you can get a sense of the size of the private investor market in this country. But, you need to choose the right angels. So that's another important starting point.
So it's often said that you start with, family, friends and fools when you start off.
Yes.
And to some extent, angel investing used to be seen as the next step up from the fools, the experts,
hopefully not
but
too many fools.
Still a smaller amount of money.
Yes. Just to give you a sense.
Am I right in thinking that now, because of angel investing clubs, much larger sums are being invested? So the industry is changing to some extent.
I think that's right. You used to think also it was very often, a very small amount of money that you got from angels, but because they syndicate, they are capable of bringing quite considerable sums. A sort of sweet spot is around £500,000. But if a group of angels really like your business, 1.5 million or £2 million can be raised by a syndicate according to the business itself. But the main point is that it's really they're looking to make sure they give you the right amount of money for the sort of stage you're at. But obviously they don't have. They build their capacity by bringing more angels together to help build the deal, as opposed to having a fund that has the capacity to start with.
I just want to bring Marina in here now, because crowdfunding is again something very different and much newer than angel investing or indeed traditional VC funding. But crowdfunding has also gone through a metamorphosis over the last few years since it started. Can you just summarise briefly how that's happened? Because your equity fundraising, so Syndicate Room, which is the firm that you work for, is equity crowdfunding. Mm-hmm. That's not quite how it started. So just in a nutshell, the difference between the two.
Sure. So although crowdfunding is a relatively young industry, there are already a number of different models out there. So it all started with rewards-based crowdfunding, where the crowd received all sorts of rewards in return for their cash. And from an entrepreneur's point of view, this tends to be more suitable if you have the sort of proposition that can genuinely excite the crowd, and it helps to have a tangible, interesting product to give away, so that platforms like Kickstarter and Indiegogo can essentially act like a pre-ordering mechanism for your soon-to-be customers. Then there is equity crowdfunding, where you have to give away shares in your company. There are already a number of different propositions within equity crowdfunding itself, but probably there are essentially two different models. There is the company-led model, where the company sets the valuation and all the terms that are then offered to the crowd, and the crowd can typically invest from as little as £10. And then there's the investor-led model, where companies already have some experienced investors on board who did their due diligence, negotiated the valuation and all the terms, and felt comfortable enough to put their own money in. So that's a more vetted model. It's a grown-up version of crowdfunding, of equity crowdfunding, if you'd like.
So talking about the crowd is perhaps a little bit disingenuous when it comes to equity crowdfunding, because this is an industry that's regulated here in the UK, and I know less about the US, but in the US and Canada as well. So you do have to be either a high net worth individual or you have to be someone who understands the industry. Is that correct?
With Syndicate Room, that is the case. We only work with high net worth individuals and sophisticated investors. But I think for other platforms, as long as you're regulated by the FCA, retail investors can also contribute.
Okay. So imagine then that in this room there are many entrepreneurs who want your money, want access to your money. How do you assess them, and who are you most? What kind of entrepreneur are you looking for? Perhaps we'll start with crowdfunding, and then Damien, I know that you're on the board of several tech startups and have seen companies right through to sale. So it will be interesting to hear from you how you view things. So imagine somebody, an entrepreneur comes to you at Syndicate Room. How are you going to decide whether or not you take them?
That's a very good question. We have a set of basic criteria. So we ask for at least 25% of the round to be in place, and they need to be able to put forward a lead investor who did their due diligence, negotiated the valuation, all the terms, and we always ask for a statement from this lead investor to better understand the motivation behind their investment. And then we ask for a business plan, the usual things, a cap table to better understand the funding history of the company. And then we ask for more information about the current funding round, so to see, to better understand the use of funds and a breakdown of what they're going to be using the funds for and what milestones are they hoping to achieve. Then we review all this, and we have an investment committee meeting every week where we discuss the opportunities that come our way.
Okay, so traditional due diligence. But
yes.
Imagine I have my startup and I'm predisposed to think about crowdfunding. I like the idea, but then I met Damien at a party, and it seemed like they had a lot of money as well. And how am I going to decide, Damien? How should I decide?
How should I decide, or how should you decide?
Well, first, how am I going to decide, and then you tell me how you would decide.
Well, look, I mean, I always tell entrepreneurs when you're speaking to an investor, and this applies, I guess, less to crowdfunding because it really is a mechanism to raise capital, whereas the other two examples here on this panel, you're really dealing with the actual investor. But when you're talking to investors, you should always ask yourself, would I be willing to work with this person if they weren't giving me money? And if the answer to that is yes, it usually means that there's a rapport there between you and the investor, which is very important. You mentioned 10, 12 years. These are long-term relationships that you're entering into with these investors. So that's first and foremost. And then secondly, can that person or firm or individual or both, hopefully, can they add value other than capital, right? And so the reality is, money is a one-time transaction. You take that money and that could be it. Maybe there's another round later. But the relationship and that so-called value add that the investor is trying to provide to you, hopefully that lasts for 10 to 12 years or however long you need. And so, I mean, you raised a great point. Do your diligence. I tell the entrepreneurs that I'm dealing with, I say, hey, look, don't let me tell you what I can do for you. Call the 20 CEOs that I've worked with over the last 10 years. And by the way, out of those 20, here are the 5 where the business has failed. You want to know what I'm like as an investor? Go talk to those 5 people, because success can hide a lot of issues. And so, the best thing to do is just call up the other entrepreneurs that the investors dealt with, and I promise you they will take your call, because it wasn't that long ago that they were in the exact same position that you're in, trying to evaluate that entrepreneur, and you would be shocked what they tell you, because again, they're trying to help their own.
Sure.
So that's
and from the firm's perspective, I mean, it's often said that the VCs get involved once the angels have put their money in, and it's they do the hard work for you, and then you move in and
what happens?
makes the next stage of the investment, and then set the terms, and so what are you looking for? What are the danger signs And what are the signs for you that this really could be an excellent bet for the firm?
So it sounds cliche, but I say it every time I have one of these sessions. We are in the business of investing in people, not businesses, right? Businesses change, markets change, people don't. And so when we meet an opportunity, when we meet a company, first of all, I'd much rather meet the company before they need financing. And the reason for that is because it allows me the time to get to know that individual. It's very hard when you come up to a firm like mine and say, hey, I need to raise $5 million and we need to close in 60 days. I can't get to know somebody in 60 days, so I'd rather meet them early. And then things I'm looking for, there's the obvious things, like you need to have intellectual property. It needs to be a large global market. Those are check boxes. But the intangible stuff all revolves around the entrepreneur. And what I'm looking for, first and foremost, is do I want to work with you for 10 years? You know, it's a long-term relationship for me as well, not just you. And then I look for things like, are you coachable? So I'll actually test you in meetings to challenge your assumptions. Whether or not I agree with what you're saying or not, I'm just going to challenge you for no other reason than to see your reaction to that. And you have to understand, that's not because I think we're going to embark on a relationship where I'm going to be constantly challenging your assumptions. But I may not, but the market will, and your competitors will. And so what I'm trying to do there is I'm trying to figure out, are you the type of individual who is going to ignore the market signs and when markets are shifting and stay on your current path to failure? Or are you going to be one of those entrepreneurs that sees things ahead of time and adapts quickly? You know, out of the last 20 businesses that I've invested in that have ultimately either failed or come to realization, I'd say maybe 2 of them were doing exactly what they said they were going to do when we first invested. And so I know that things are going to change, and I want to try and get into your head and see, are you an individual that can actually change along with that? It's very, very important.
So that takes time, as you say, more than the 60 days that you might expect from, starting to make the pitch to the investor. For angel investors and for crowdfunding firms, is it any different? And because a crowdfunding firm it's much more diffused than it is with a relationship with a VC. Perhaps start with crowdfunding and then the angel investing side.
Is it really different in terms of?
In terms of how you assess the companies.
Mm-hmm.
I mean, are you willing to take a different kind of bet?
So I think that we try to curate the platform as much as possible and to offer our members the sort of best opportunities that we see. And then it's up to them, it's discretionary whether they would like to invest or not. But that being said, we've recently announced that we're going to raise our own fund. And the way the fund is going to work is that it's going to match the appetite of our sophisticated investors. So that's where we'll start becoming much more involved, I guess, in the businesses.
Sure. And what about angel investors, Jenny, in your experience? The behaviour, the mindset, the way they're looking to interact with the entrepreneurs they choose?
Obviously, same, and I think I've already mentioned this, it's very much about the entrepreneur, and we don't spend as many hours and hours and hours as a VC does in doing due diligence. And so we're probably going to spend about 20 hours in assessing a business. And therefore, that is going to be more than anything, the entrepreneur themselves and the team, if there is one. So we spend most of our time just talking to the entrepreneur and the team and getting you to answer our questions and obviously address any doubts or concerns we have, rather than looking in detail at your business plan, for example. We know that business plans change. We all regularly rip them up after a year or so. Please don't give me very long ones either. I want really short ones that I can understand. But the main thing is that it is about you, and we've just, Damien obviously mentioned exactly the same things. And we look for someone who's got real passion and commitment, who's really going to work with that business, and who is, convinced, as you've got to convince me that you are convinced about that idea, so that we have the same sense of the potential of that business, and that we therefore are aligned in believing that that business will grow. And I have to believe that you as an entrepreneur have both the commitment and the passion and hopefully the skills to take that business through to fruition. I mean, I do look at other things because I look to see that you're bringing understanding of your business. So I expect you to be able to have done your research. So I'm not going to go into all that research. I want you to be able to tell me the research you've done that tells me you've got how you're going to attack that market. And I expect you to be able to show me that you have talked to customers or you totally understand at least who your customers are. And most of all, I'm expecting you to be able to show me and tell me how you're going to make money, because I want you to make money, because that's what's obviously going to bring me money and bring a return. So I'm really going to focus on you and your knowledge and your understanding. And if you can't answer the questions or go away and come back quickly with those answers, then I will probably walk away from you thinking you don't understand your business enough and you don't have enough commitment to really understand the business enough to be able to help me to understand it.
So before we finish, I'd like us to think about future trends.
Yes.
And perhaps while we're taking questions, you can all think about, your own sense of where the most exciting opportunities are. But I'd like to sort of open it up to all of us and take a few questions. So,
hi, I'm Robert Hawkins. Thanks for being here. So I spent more than 25 years in my career, and on the basis of my career, working with a lot of blue chip clients. I've come out of that and I've created an idea for venture. I'm looking for investment. One of the things, I've raised investment twice before with previous ventures, and one of the things you guys have both talked about, the importance of the entrepreneur. And the thing that I see out there right now is a lot of, with due respect to my younger colleagues, I see a lot of 27-year-olds who are kind of doing it because they think business is cool, or certainly the impression I've got. There's a business that has just raised funds in an area similar to mine. They've raised £3 million. This guy's gotten coverage. He was in Forbes, and in this course of this interview, he says, I went to this accelerator program in Italy. I had 100 business ideas. I met this guy, and we came up with this one idea, and then we won 50 grand, and now they're in London. And he, in the course of his interview with Forbes, he said, we're piloting the business. We still don't know who we're selling to. And I'm looking at this guy, and I'm going, it feels like there's so many of these guys out there that are just kind of, it's cool to be in business, let's get into business. And here I am with a guy with lots of experience. Unfortunately, I met with an investor yesterday who said, you have a heavy hitter team, and guys there'll be people willing to just give you money because they know you can get stuff done. So my question is, you guys both spend a lot of time talking about the quality of the investor, and it seems to me like there's a lot of guys that just have hot ideas. Mm-hmm. And so how are these guys getting funded, and how do I go about it?
Okay, so perhaps we'll start with Damien. So how is it that so many people are getting funded?
Yeah, the world has changed a lot in the last 5 years. I've been in this business now for 20, investing 10 of those. And I would define the last 5 years as very simply a period of extreme liquidity. So there is more capital in the market today than ever before in history, period, end of story. And a lot of that capital is focused on the early stage companies. I have the data. So in 2005, when you compare 2005 to 2015, and you look, this is North American data, but you can generally apply it across the world. When you look at the number of early stage companies that were funded in 2005 to 2015, that increase was 10x. Okay, so 10 times more companies 10 years later. When you look at that same data for Series B and C rounds, so those later stage of financings, it's increased 2x. So what does that tell me? It tells me that there's just way more companies being funded early on. And there's reasons for that. We talked about capital. It's cheaper to start a business today. We were just talking earlier, 5 years ago, to start a tech company, you had to build your own servers, right? It's a phone call today to Amazon, and you can be up and running in a day. And so, yes, that creates challenges for you as an entrepreneur because the competitive environment has lifted. There's also, I say there's CEO-itis out there. Everybody graduating now wants to be CEO. It's the trendy thing to do. What I would say to you, and I feel that frustration that maybe you're feeling, is don't let it frustrate you, because an individual with your experience is going to clearly stand out from the others that you've described as somebody with deep, deep domain experience. And that's, when we're talking about, have you done your homework and do you know what you're talking about? That should come out tenfold when you've got that experience. And so my best advice is ignore the noise. I mean, because you're going to be one of those 2x and not one of the 10x.
So, sorry, Jenny.
No, I should say, I mean, I agree, but I think, it's all that's certainly true about the wave of capital and the wave of entrepreneurs that we have here. We have amazing tax breaks in this country, which I haven't mentioned because obviously, unless you're investors, it's not so interesting to you. But the fact we have a huge tax break, and in 2012, our government brought in a 50% tax break if you invest in an early stage startup here. So I, as an investor, can put £100,000 behind early stage businesses that are looking for less than 150,000 each year, and I get 50% of that back straight from the government, plus capital gains tax relief, plus inheritance tax relief. If you go pear-shaped, I get a loss relief. This has been obviously a huge basis of the crowdfunding scene as well here. So there is a massive incentive for people in this country to put money behind small businesses. So I have seen, as the trade body, this wave of new investors, not of all of whom know what they're doing, I might add, and a wave of entrepreneurs coming through accelerators. So it is a big concern in that there's a lot of easy money out there. But I totally agree with Damien that whilst that is out there, the serious, savvy angels are looking for companies and entrepreneurs that totally have been there and done it, know what they're doing, and can really build a business of scale. And we are looking for people like you because we know that between 60 and 70% of our investments as angels will fail in our portfolio, never return the stake money. We're looking for those that bring us the returns. So, amongst all this, you will come through, I'm sure.
That might be an invitation for a conversation later. So, Maruna, how many of the entrepreneurs or the companies who get funded through the crowdfunding firm that you are involved in have come out of the accelerator movement, if you like?
Quite a lot, but because we typically tend to look at more mature businesses rather than general crowdfunding platforms. We do tend to see cohorts who probably graduated from an accelerator 2 or 3 years ago. And
so what level is maturity for you then? 2 or 3 years from actually the idea in the garage?
It depends on the type of accelerator as well, because now we're seeing accelerators like Entrepreneur First, where they accept just amazing talent and then they form the teams and start the companies there. So when they leave the accelerator after 6 months, they are still quite early stage. In terms of campaigns that are successful, we've tried to look at patterns. And one of the things that comes up a lot is that successful entrepreneurs mention not only what they're doing, but why they're doing it. So the motivation behind it all. And I think this helps a lot in attracting the right sort of investors for you, because the right sort of investors are going to resonate with your motivation, and they're going to be able to help you much more throughout the journey.
I've got one question. I'm really interested, obviously, the success factors. Okay, thank you. Yeah, obviously, it's interesting to know why companies succeed, clearly. But I've also got a question for Anne in terms of why companies fail, because clearly identifying the factors of failure you could instill mitigating factors to future investments.
Okay, Damien first.
Why companies fail?
Or perhaps we should look at why companies fail when they you invest in a company and then it doesn't go much further.
So let me give you a bit of a backwards answer. It's harder for companies to fail today, and that's not a good thing. So what you're hearing a lot of us talk about is the amount of liquidity in the market, and I'm sorry for those that it's usually in a room full of entrepreneurs. There's always one or two that are like, oh, I'm trying to raise money and I can't. So you're full of it. But generally speaking, it's so easy to raise capital that typically you're raising capital maybe sometimes when you shouldn't be able to, and you're raising too much capital, and capital can actually hide failure. It can, and not even failure has a negative connotation to it. Maybe it's just things have changed, markets have changed, and what you're working on is no longer well positioned to actually succeed in that market. The issue with raising so much capital is time, right? The worst thing you can do as an entrepreneur is spend 5 years and have nothing to show for it at the end. If you're going to fail fast, right? And I've actually sat down with young entrepreneurs who have had the option of raising $5 or $10 million, and I've actually counseled them. These are not companies that I've invested in. I've said, take the 5, because if you don't need the extra 5, I can't describe to you the amount of pressure that you're going to be put under to spend that money when you raise that additional capital. And then also that capital will hide certain things and indicators in your business that things aren't going right. And it's going to take a story that should take a year, and it's going to turn it to 4, which can be detrimental for you as an entrepreneur.
I mean, that's not the question I was asking. I mean, the question I was asking was, if I'm saying 60 to 70% of businesses fail, then clearly, why did they fail?
Well, I think this is a very, this is a really, really wide question. I think Damien's answered it in part.
Yeah.
Perhaps we can have a conversation. You can have a conversation at the end of this. But I think there's a question at the back, David.
So it sounds like maybe the idea isn't maybe quite as important, you can tell me if I'm wrong, as the team. So maybe you could tell us as entrepreneurs, what should they be developing in themselves? Is it grit? Is it, am I asking the right question too?
Good question.
Jenny.
I think it's a really good question, because you're kind of saying, can I develop myself as the right entrepreneur, or am I born like this? I mean, obviously, I think some people have definitely, for whatever reasons, have got it in their DNA. I mean, and I've certainly seen that, and sometimes it's just from kind of family, coming from families of entrepreneurs. But I actually think that for me, and obviously you can never, what we're looking for is for you not to pretend, to be what you aren't. But we're looking for people, with the passion and the tenacity, but also the power to learn. And I think Damien mentioned that too. I mean, we're looking for someone who is flexible, can evolve. So it isn't about being just as you are now, because as you are starting a business, you will need to have all different kinds of skills and talents as you grow your business. And a lot of that is about being a very flexible person, about listening to advice, about being able to change, understanding change, and also leadership, ambition. I look for those kind of things. You may not yet be leading anyone, but I look to see that you really can have the powers to lead, and that means bringing a team together successfully and knowing how to delegate and things like that. And a lot of that stuff is very difficult for us to tell early. I know some angels, and I don't know whether you do, Damon, I know some angels who do psychometric testing, for example, to try and find out if you're a strong leader and if you've got what it takes, etc. I don't have time for that, so I'm really just going to find that out through conversation. But I have to say certain things are quite interesting. First of all, I always look at your LinkedIn profile, so I hope you've got that up to date. I also look at your Facebook profile, so if you've been doing any exciting parties and things that you've been putting on Facebook lately, I'll look at that, not just to find out if you're fun people, but to find out if you've been doing crazy things. So you have to kind of look at your self-image, in social media as well as what we can find out from you. But I don't have time to do psychometric testing, so I'm going on a lot of instinct from knowing so many entrepreneurs over the years that I kind of know, I hope, the right skills when I see them.
Okay. I think we had a question over here.
So this is a slightly naive question, so apologies in advance. But we have a health startup at the university, run by through two professors and myself, we're all doctors. And we have a very strong board, so we're very fortunate. We have the chairman of a bank on our board, we have 2 fund managers on the board, we have 2 high net worth on the board, so we have access to lots of different things. The disadvantage is that we get lots of different advice from them. So even the private equity people are saying, we can, we're the best people, we long-term follow-on and all this kind of business. So the question really is, how should we decide ultimately? Do we decide amongst the founders? Do we decide by listening to the board? Do we need to have more conversations with people like yourselves? Is this just simply a too naive question to have an answer?
I don't think any question
Thank
is
you
too
very much.
naive, actually.
It's
So
actually a great
I think I'd
question.
like all of you to have a stab at answering that briefly. So Maruna first.
I think it's very important, first of all, to be aware of all the different opinions and speak to as many people as possible. And even when it comes to funding routes, speak to as many people as possible and do your research almost like you do your market research for your product or offering. Research the market of money and see where do you think what route suits you best. But at the end of the day, it's probably up to the founding team to decide how to best move forward.
Jenny, briefly.
I actually think it's quite a dilemma, particularly when you're valuing all those different pieces of advice and to kind of prioritise among that. I mean, I do tend to agree, Maroon, in the end, it is your business. I mean, the one thing we want to be as investors is to be sure that you are running the business, not other people running your business. So in the end, it is going to be down to you to make those decisions. But you do have to be where you can be. Particularly if you're talking about your investors, you need to be aligned to your investors. And I think that's very important and feel that you can trust those people. But I would be looking for you to feel the confidence in your decisions that you can, move forward yourself whilst, taking account of expertise.
Okay. Damien, it's not unknown for VC firms to force a change on the board. But what advice would you give in this situation?
I mean, first of all, I think it's a fantastic question, not a bad one. And it's a problem a lot of founders face, and this is going to seem, it may seem funny coming from an investor who sits on a lot of boards. The best advice, which is similar to my colleagues here, listen and then make a decision. And the worst thing you can do is trying to appease everybody. And I'm actually going to respectfully disagree to just one comment that was made here with referring to a founding team, because that's a problem in a problem I see very often, is when you are a founding team and you start something together, there's this natural inclination to be very cohesive in making decisions. You need a CEO. You need, as a team and as a board, you need to appoint one person to ultimately make the decision for the business. And listen, frankly, if the founding team or if your other board members ultimately aren't happy with the decisions that you're making, then they need to make a decision on whether or not you're the right person to do it. So in a role as a CEO, you need to have the confidence to actually step forward, seek advice, give an opinion, and then make a decision. And I think if you approach it that way, you'll find people will naturally let you take on that ownership because you'll give them comfort, frankly. The worst thing for me is sitting on a board and having a CEO just come and ask questions all the time. And at some point I go, whoa, you know your business better than I do. What do you think? And I'll challenge what you say, but ultimately I want you to make the decision.
A few more questions. Okay, we haven't had one from over here, this gentleman. But we'll go here and then there.
Thank you. I'm Eric. I'm the founder of Digital Fine Print. My question is, which metrics are the most important when you're looking at investments for the different types of investments you're making? My startup won the prize for best startup idea in the UK, and we got accepted to an accelerator at the biggest insurance firm in the world. But those are more vanity metrics. I'm wondering if we need to look at revenue, users, or anything else that's important.
Yeah.
Thank you.
Maybe I'll take that one because I'm probably seeing more metrics than the early stage. You're right. So I'm less interested in those vanity metrics as you describe them. It's a great description. Depending on the business, obviously, but in most businesses today, I try and get into I'm looking at cohort data first and foremost, because what you'll find is different groups of users, depending on when they've been added to your platform. You're evolving at such a rapid pace that somebody who came in January has a very different experience than somebody who may come in April. So first I'm looking at cohort data. And then secondly, and most importantly, is instead of the top line growth metrics, I'm more interested in engagement metrics, in churn. So I want to see, I'm less concerned about absolute numbers and more concerned about when you get those users, what do you do with them? Are you able to retain them? Because I know when I'm looking at opportunity, you can buy users today. Growth is the easy part. Keeping them is the hard part. And so I'm trying to look in subsegments of your business to see proof that you actually have those kind of engagement metrics.
And just to add to that, I mean, I rather feel the same because so many people using freemium methods at first, where you're just saying, I've got, you know, so many thousands of users stroke customers. I mean, I actually don't really find that interesting until you can actually show me how that's actually going to convert into revenue, and that those will be longer term, you know, subscribers. Because it is so easy at this point to have so many followers and so many users without that actually leading in the end to real revenue and, you know, and real substance. And it's something I think that we all worry about a bit, because it is really the classic model often of how you're demonstrating it if you've got that kind of a business. And it's often hard, it's so much easier. That's when we're judging more solid kind of businesses where you've got kind of real customers and you can, you know, really see that repeat customer and actual revenue being turned over. And it's something we all have to kind of take account of, and in many ways, we've just got to understand how you're going to do it rather than you can see it at this moment.
You've got a notepad there, write this down, and I don't have time to get into it now, but write down quick ratio, and sending a plug for a colleague of mine that I sit on a board with. It's by a guy named Mamoon from Social Plus Capital. There's a full presentation on SlideShare that you can get online, and it's a fantastic example of one of the metrics that investors are looking at today, which keys in on all the stuff that we're kind of talking about. Quick ratio.
Lots of people taking notes, which is good, always good. So, gentleman at the end.
Thank you. And so I'm interested in, of course, the investors usually have a field of interest that they focus on. And for my company that I'm starting, I'm in a niche field of the biotechnology. And I was kind of, what kind of checklist do you kind of have to kind of decide whether or not to take a risk within a field that you might be in or might not be connected to, but kind of are willing to look into a company or kind of investigate it further?
Okay, so it might be good here to talk a little bit about different specializations across firms, which is easier in the VC sphere perhaps than in the angel investor sphere. But Maruna, could you talk a little bit about how specialization is developing in the crowdfunding market?
Sure. So we are sector agnostic, as most crowdfunding platforms. But that being said, more than a third of our portfolio is within life sciences, actually, which is always interesting to mention because, at least at the beginning, crowdfunding was more associated with B2C consumer-friendly propositions. But I think that having a lead investor on board, who's usually very well experienced within that industry, helps platforms like ourselves work with different sectors efficiently, because we have that expertise already, and then we can sort of rely on it to a certain extent.
Damien, do you want to say something about VC specialization?
Yeah, sure. So, you know, most VCs in North America, you'll find they're very sector specific as you get down to the partner level. So you'll have a firm that will cover many industries, but you know, you may have one partner at the firm that comes from the telco space, so they'll invest in that. And at OMERS, we're a little different because we're Canadian and because of the size of the market. When we're investing in Canada, we tend to be generalists. And so maybe I can actually answer your question better because of that, because I do look at opportunities that maybe are in a vertical that I'm not necessarily an expert in. And what I'd say to try and answer is I'm always looking for, while verticals change, there's themes across our globe today that remain relatively consistent across those verticals. And so that's kind of what I'm keying in on. And I'm looking for themes within your vertical that are having, you've got to remember the size I'm dealing with here. So you need to be having material impact on a change in an industry. Are you know, cliche, are you changing the world? Are you know, we're looking at a company that is literally taking the publishing industry and flipping it on its head. You know, you need to have that material type of shift in a vertical ultimately to create billion-dollar opportunities. It's not to say you can't create a billion-dollar company doing something that's being done already today. It's just much lower likelihood and much more risky for me as an investor. So we're looking for themes within the vertical that you're in, and that can be common across many verticals.
From my point of view, I wouldn't invest in biotech because I don't know it and don't understand it, and that is the right answer from an angel. Never let an angel give you money who says, I don't understand your business, but I'll give you some money. So you know, there are only a relatively few angels in this country who are really expert in biotech. And those are leaders and tend to have a syndicate, you know, behind them as well. And some of those actually are investing on syndicate room because actually they're, I have to say it in this room, they are the Cambridge group of angels, many of whom are very experienced in biotech and come from the industry. That's why they invest. So you've always got to make sure that if you're taking, you know, angel money, that it is absolutely someone who is leading, who understands your industry, and then they can bring you real value. And you know, just because it's money, don't take it. And someone says, I don't get it, but I can bring you the money because you want all of the other value pieces as well. The reason angels often don't invest in this sector because you need a lot of money. You need a lot more money than we can probably give you, and because it's a long developmental period. The only time we might do it is if we can see a short milestone where we know we could pass on the baton to a bigger VC, or where, you know, we can see there is a buyer in the relatively to take you to the next level.
I think perhaps that's a good point to ask all three of you. What's the threshold, or perhaps what's the average even investment in syndicate room, and then, you know, amongst the angels, you know, and then how much money would somebody be raising before you would look at it, Damien? So, Maruna.
So we've done rounds anywhere in between 150,000, the classic SEIS round, all the way up to 3 million. This is the sort of range, but the average would be 700K at the moment.
Okay. Jenny.
I think that most syndicates in the UK, their sweet spot is around £500,000, and I'm talking about syndicates. But I mean, you know, on the same vein, you know, if you've got a group of angels that really like your business and feel it has huge potential, they will dip in and bring others around them to build a syndicate to probably 1.5 million too. And the reason angels don't go much beyond that is because they want to hold some money back for further rounds. So, you know, they're being sensible in what they can do.
So does it help that you've had a lead investor already?
So if you've had a lead...
If you have a lead investor or a non-executive member who, say, has a connection to the angels, would you feel that's okay for the angel network then, as you said before, that it's usually good if the angel has expertise with them?
Yes, yeah, no, I mean, angels will come alongside someone who's taking a lead like that. I mean, they're likely to be slightly more passive angels, potentially. You're looking to build the round with one very strong lead angel who's going to sit on your board or be really hands-on in your company. And the angel, you know, and I will do my due diligence a lot on that person and make sure that it's someone that I would want to put my money, because I'm putting my money behind that person's skills as well as behind you. So yes, that's perfectly fine to be able to have someone who takes the lead for you in that way.
Damien.
Yeah, I think, you know, one of the effects of the amount of capital in the market, this common theme of what we're talking about, is that the lines have been completely blurred in between the multiple rounds of financing. So, you know, my answer, which is going to completely overlap over here, is we'll go, you know, as low as $500,000, and we're actually looking in our third fund to carve off 10% of our fund. We're bringing in an individual who's extremely connected in the early stage market, and we're allowing him to go out and write checks as small as $100,000. And again, the market has gotten so competitive that large funds like ourselves, which historically we wouldn't be interested in writing less than a couple million, we're now willing to go almost pre-seed. So angel rounds, we're willing to go into angel rounds in order to develop those relationships with who we believe are the top entrepreneurs, to give ourselves a position to then be able to lead the later round.
See, it's
So this is
dog
good. This is
terrible.
good.
Yeah.
Good for all you budding entrepreneurs.
Yeah.
Okay?
Yeah, we're
So
going to
we
have a fight.
have this gentleman and then this gentleman here.
Thank you. So it's a bit of a follow-on question, actually, from the previous two. Our position is slightly odd in the sense that we are pre-launch and pre-revenue, but we've also done what we are going to do commercially. We've done it academically, and we've done it at a global scale. So we've engaged with tens of thousands of our users at a global scale, and we've had quite a sizable funding from people like Bill Gates. You know, they've made grant funding, you know, to us, which has been really good. But it does mean
Doing
that
a good sell.
Well, it's absolutely exactly right. Yeah,
Keep going.
as you can probably tell from my questions, we're just at our kind of fundraising stage at the moment. But I just wondered, are there different approaches that the three of you would use in order to value a company at this kind of level? Because I was similar to the biotech chap. You'll have a particular view on your value that maybe not be shared by different sources of investors, and I just wondered what the differences are between the three, if I may.
Thank you. So if we keep answers fairly brief, and we'll take another question afterwards.
Loaded question. I mean, valuation, here's the real answer, which not a lot of people will tell you, is like, go like this. And I'm not kidding. So if there's metrics, if you have revenue, then yes, we will justify our valuation by using metrics. But the reality is, we're looking at gut feel. What do we think the size of the opportunity is? How much money do we think you're going to need to raise over time? And then we underwrite based on that. So we really are looking backwards. And I'd say a rule of thumb when you're talking to a large institution is when we go out and deal with companies is typically we don't like to see companies giving up over 30% dilution. Over 30%, I would sit there and go, ugh, you're either taking too much money or you're not getting proper value for your company. And that general rule of thumb of 20 to 30% per round of equity that gets you 18 to 24 months of runway, that's a good kind of starting point.
Okay. Fairly brief answers. Okay, Jenny.
Very similarly, Angel, it's not a science, it's an art, and it's through experience that you get to know the value. And I would say just a general answer to everyone, if you are pre-revenue as angels, we would tend to never value your business more than $1 million and more likely $500,000 if you haven't got anything really on the table to show us. If you've got stuff on the table, then it's working back from there.
Okay.
We don't really get involved in the negotiation of the valuation as such, but if it strikes us as particularly high, then we will have a conversation with the lead investor to sort of understand better the reasoning behind his negotiation.
Okay. So one more question from this gentleman here.
Great. Thank you. So a lot of these comments and stories I'm hearing in terms of how there's so much money out there right now, and then it even seems like there's undeserving people getting money. Is it like that? Honestly, seems like a red flag for a bubble. Like, do you guys feel like there's going to be a major correction in the amount of equity available? Like, do you see that looming? I mean, obviously nobody can ever predict the future, but a lot of these seem like red flags to myself.
Okay, good question. So first, I think we'll go for the newest kid on the block here.
I was just thinking that with crowdfunding, everyone is sort of starting to become a bit anxious with regards to exits because there is a lot of money being put into all these companies, but we don't really get to see how far they manage to go following the crowdfunding campaign. So I think we'll have to wait and see what the returns are like.
So sitting on the fence answer from Jenny, are you going to sit on the fence or give me a straight answer?
No, I'm not sitting on the fence. I think there'll be a correction in the market in the next few years, mainly driven by crowdfunding because of the over-expectation of returns and outcomes. And because this wall can't keep going, we are expecting 67% failure from angels. Crowdfunding, it's going to be 90% or upwards. There will be a little trail of destruction. There will be a correction. Good crowdfunding platforms will remain in that marketplace.
Okay, trail of destruction, Damien.
Yeah, no, look, I actually think I think we are actually going through a natural correction today. If you look at some of the metrics out in the market, we hit an all-time high for valuation multiples in Q3 of 2015. Since then, valuation multiples have been coming down. The IPO market has dried up in the tech space considerably. That's an initial sign. But the good news is something I was kind of talking about a year ago is you have a lot of really large companies, public companies in a lot of cases, that are sitting on very healthy balance sheets. And these are companies that their growth rates are starting to slow down. And you're already seeing evidence of it in the last couple of months. M&A activity should start to increase. This is private M&A. So, LinkedIn is a perfect example. You've got a company like Microsoft who is just starving for growth. They have no other choice. They're either going to increase their dividends or they're going to start buying up companies. And the latter is much easier when you're a public company.
Okay, so we have to end in a minute. I just want to give each member of the panel just 1 minute, no more, to say something interesting about future trends and the most interesting sectors, whether it's the kind of companies that you think we all ought to be watching out for. So your last pieces of wisdom from each member of the panel. Miruna.
So 2 quick things. I think that we'll see more and more hybrid rounds. So there will be more co-investment and collaboration within the financing sector, just because there are different elements, there are different benefits to different funding routes. So VCs and angels can bring the expertise, then you can get the brand ambassadors and the exposure through crowdfunding, for example. And then the second trend is probably the rise of impact investing. I think that's partially because there's an increased sense of urgency around some of the bigger issues in the world. And then there are also more and more people who realize that there doesn't have to be a compromise between doing the right thing and being a commercial success.
Okay. Jenny, very briefly.
Yeah, I think we are going to hopefully shift our attention from startup to scale up, and that's not to be terrible to you guys who are in startup mode, but the only rationale for any of this is that we're all focused on scale up and growing great businesses, which is across the board amongst the investment community, those who really are in for the long term. And in terms of kind of where opportunities lie, I am very absolutely backing data and the whole area, everything that is using data, big data, and the whole intelligence and using data and artificial intelligence, I think is going to be absolutely huge. And I know many angels are really interested in that.
Great.
Yeah, great
Jamie.
segue. So I'm really interested, and I think we're into an interesting time, the evolution of machine learning and AI within enterprise. So this idea that today you go into work, you start up your computer, and you open some type of enterprise system and you ask it a question, you ask it to do something. If any of you working in enterprise solutions at all, you have to be thinking about machine learning and AI, because we are approaching a point in time very quickly, very soon, where you're no longer in that situation going to go in and ask anything. You're going to have enterprise solutions tell you what you otherwise would have asked hopefully before you even know you need to ask it. And you're going to see that trend cross every vertical, whether you're consumer or enterprise tech or biotech or whatever. That's where we're heading, and I think it's actually a really, really interesting time to be an investor.
Agreed.
Okay, thank you. That was a fascinating discussion. And I know, Tarek, you want to close up for us.
No, so it's basically this concludes our panel discussion for the afternoon. I'd like to ask you all to join me in thanking our panel and moderator.